A lot of investors have gone through the volatility in the markets the past couple of years and are looking for stability right now. Even more investors are looking for income they can count on, trying to find stocks that are going to be able to pay them and they can hold them for the long term. So today we're going to talk about two high yield dividend stocks that we think are worth buying right now. I'm Jason Hall. This is The Smattering. I'm joined by Tyler Crowe. Hey, Tyler.
How's it going?
I'm good. I know you've got a great stock to talk about here that's probably under a lot of people's radar. Before you bring it to the table, though, I just want to remind folks that we get to do these videos because of our partnership with the Motley Fool. If you're looking for more great stock ideas, even than the two we're going to talk about now, go to our special link, fool.com/The Smattering. The Fool's going to give you their 10 best stocks to buy right now. Okay, Tyler, what's your ultra high yield dividend stock you want to talk about today?
Sure. Ultra high yield company that I want to talk about right now is Rio Tinto. Now, for those that don't know it, it's one of the largest diversified mining companies in the world. And I think a lot of people's initial reaction to miners is to go, low return, high debt companies in, cyclical commodities. No, thank you. And that's a fair, but I would argue that I think some of those are myths right now. Let's start with, for example, balance sheet debt. Rio Tinto in the past 6 years has gone from about $14 billion in net debt to a positive cash position. Their operations have been so efficient, they've been so good at cutting costs and generating good returns from their existing assets that they are now in a position where they're essentially debt-free. So it gives them a lot of flexibility going forward on how they make investments. Number two, low return. Over the past 3 years, the return on capital employed at Rio Tinto has been above 20%, and it is 34% now. And then on the cyclical side, yes, I will not argue in any way that mining is not cyclical. It is, and we're likely maybe someday going to see a decline after a boom time. But I do legitimately think that there are some secular trends over the next 7 to 10 years that are going to play out very well for Rio Tinto because of the three things that they mine most prominently, and that's steel, copper, and aluminum. Copper and aluminum are going to be some of the foundational metals needed for the electrification of everything. Lightweight, high-strength aluminum is going to, for electric vehicles and things like that, drastically improve efficiency on other vehicles as well. Steel is the lifeblood, much like oil in terms of economic growth. You need steel just to make anything like that happen. So there's secular growth on that end. And copper, the expectations for copper demand with wiring, electric vehicles, and just like I said, the electrification of everything, massive demand spikes over the next couple of years. As of right now, Rio Tinto trades for about 6 times earnings and has a yield of 9.7%. To be fair, it's a variable rate dividend. They pay about 40 to 60% of their earnings based on where they are in the cycle. So just keep that in mind that 9.7 isn't to the T what you're going to get, but at that kind of yield, it's pretty hard to ignore this as a high yield investment right now.
I think it's worth adding too, Tyler, that even while the yield is variable, as you see on the screen, the long tail continues to be growing that average payout over time. And that's really important, right?
Yeah.
Okay, Tyler, I'm gonna shift directions here a little bit. We're gonna get out of the dirt here and we're gonna walk into the pharmacy. I want to talk about Walgreens Boots Alliance. So Tyler, you and I were talking a little bit before, and you kind of kiddingly pointed out that you can't remember the last time you actually went into a pharmacy and it was an excellent experience, a great retail experience. And I think that's true. But I think what Walgreens is looking to do doesn't require that to have to be the case. So let's make the case for where Walgreens is coming from and why I think it's really compelling right now. And I think as a starting point, the thing that's really interesting to me is that Walgreens is following a little bit of CVS Health and the approach that CVS Health has taken, and that is bringing more parts of the healthcare experience into its retail locations. And Walgreens is in the process now of adding physical healthcare into its retail locations. They only have a few dozen at this point. They're looking to bring that to hundreds and hundreds. I think almost 1,000 is the goal sometime in the next several years. The idea is leveraging that footprint of real estate the company has established over the decades, increase access to care, particularly increase access to low-cost care versus the limited access that people have now, particularly that maybe they don't have the best insurance, but they still have some sort of coverage and they need quick care. So it's a really smart model, and it's going to continue to help drive traffic to their stores. At the same time, Walgreens has done a great job of driving down costs, starting to embrace e-commerce and digital transactions. They've already cut about $2 billion in operating costs, and they're beginning to make digital transactions a larger and larger part of their business. At recent prices, the stock trades for around 9 times earnings. I'm not saying it necessarily deserves to trade for a significantly higher multiple, because this is going to be a relatively low growth business, but their ability to generate operating leverage and drive their traffic up a little bit, paying 9 times earnings for a stock that has been able to grow its dividend every year for almost 48 years straight. And at that 9 times earnings, the stock has fallen to a point where the dividend yield is around 4.7%. That makes this a really attractive, stable business. They've gone through the majority of their turnaround. And at this point, it looks really like a value stock that I think is going to continue to reward investors over the long term.